which has been endorsed by the former Chief Minister of Karnataka. She has also been a faculty member on the GST certificate course by ICI. And beyond her writing and teaching endeavors, Annapurna also plays an instrumental role in developing study modules for Karnataka state GST officers and contributes as a faculty member to the Fiscal Policy Institute, and NASIN. She is also recognized as the co-chairperson of the State Tax Committee of FKCCI. She is also renowned for engaging presentation on indirect tax matters, addressing diverse audience, including chartered accountants, tax practitioners, dealers, students, and departmental law officers across various forums. A brief introduction, ma'am. All over to you. Thank you.
मैडम आप अनम्यूट प्लीज। मैडम अनम्यूट करिए, आपकी आवाज नहीं आ रही।
Good evening, everybody. First of all, I thank CGPI for giving me an opportunity to share few insights on the topic of implication of GST on education sector. I think very few of us would have spent time for this education service because we always believe that it is an exempted sector and it may not have many as such impact as such. And basically, once I started thinking on that implication, I was able to see that there are few intricacies, few thoughts which was there when I was doing on this education sector. And I don't know whether I'll be taking up to 6 o'clock because very few things are there. But if I complete before 6 o'clock, I would like to ask Vishal that you can take it forward because I know that you have to touch upon the other two sectors that is also most important on textile and real estate. So with that introduction, I would like to take a session on this. Basically, this is more or less the similar what we are discussing for other industry. The similar first impact is change in the rate of taxes. So as a education services, there is no such change in the rate of tax, but the products which are dealt by the education services, that has an implication of taxes where they have given an exemption from a higher rate of 18% to exemption or 5% to exemption or 12% to exemption. So that is the major relief to the education sector, what I was able to look into that. So if I see this, uh, the important part is like exercise books, I am able to see craft books, laboratory notebooks, journals, periodicals, maps, pencil sharpeners, pencil erasers. These are the few items where it was leviable at 12%. So now the rate of taxes are reduced to exemption. So indirectly, we are able to understand that government is looking education services as only not as a commercial, but it's only in the so statutory service or social service. So with that aspect, they are trying to reduce the rate of taxes wherever the education sector was paying the taxes on those type of products. So first issue which arises today is when the education service is given by an educational institution, and these are all the products which are also given by the educational institution. Today we are able to see that, yes. Today, yeah, sure, thank you. Today, we are able to see that many of the education sector, we always believe that all the services given by an educational institution to its students, staff is always an exempted. But why, if the books are given in ancillary to the education service, whether this also can fall into the exemption? So this was always an issue. But basically, we have seen that the exemption is only for the services and exemption was never there for the goods. That's the reason most of the educational institutions were getting registered under the GST law whenever they were supplying this kind of goods to the students and they were paying the GST, as well as they were trying to avail the credit to the extent whatever they have used it for selling this product. But basically, we are able to see that this is not a products which are sold in day-to-day basis. These are the products which are generally sold at the beginning of the academic year, where they try to sell this product, these goods to the students, and accordingly, they are charging the taxes. But the issue here is Sometimes the educational institution will appoint the outside person. He comes to the school and try to sell all these goods to the students. And basically, based on revenue share basis, the school enter into a contract with these vendors, and accordingly, they try to levy the GST on this aspect. So whether it is levied by vendor or whether it is levied by the schools, it is automatic. It is now being exempted. Otherwise, earlier this was becoming part of the cost for the education institution. So as of now, I believe that at least to the extent of exemption, to the extent of that reduction of rate of tax, definitely the price will be reduced to the students who are buying these goods as such. And even if they are going to buy this from the vendors, also the rate has been exempted. So to that extent, I think there is no impact of tax as such. But the issue here is only the few products which are dealt by the educational institutions are reduced. There are few more products which will be goods which will be dealt by the educational institution, like laboratory chemicals and all, which they use it for day-to-day testing of the students. So those kind of products, there is no such reduction as such. Only the products which are directly used by the students are being given an exemption. So like pencil sharpeners, maps, exercise books. So this is the one aspect. And second aspect is when the recommendation was going on, the issue here, it was discussed that for the exercise books, laboratory notebooks and all, the rate of tax has been reduced from 12% to 0%. But there are certain uncoated papers which are used only for the purpose of exercise books. So here, if you see here, they have stated that uncoated paper and paperboard of a kind used for writing, printing or other graphic other than the paper of heading used for exercise books. So it means if the books are used for the exercise books or graph books, we are not able to, because we have seen that few products have gone to 18% also in the paper industry. And those papers which are used for paper exercise books or workbooks, for them it is becoming a huge cost, because on one hand, on inward supply, they are paying the taxes. On the other hand, outward supply, there is an exemption. So to that extent, it is adding a cost to the manufacturing of books industry. Otherwise, as such, there is a specific exemption for all these kind of goods which are used by the students. So next is even this mathematical boxes, geometry boxes, whatever I'm just trying to look here is the products which are directly dealt by the students have been given as an exemption. And here there is a reduction of taxes from 12% to 5%. Even on the school bags, there is a reduction of tax from 12% to 5%. And if the cements, I think Vishal will be talking in detail on this aspect, but if the cement is used for the maintenance of building, then to that extent, there is a uh, that will be always it was a cost, because they were paying 28% and GST for maintaining the school when they were procuring that cement for maintaining. Now instead of 28%, they will be paying as 18%. So this is the one aspect. Now, the second important aspect is like we were able to see that I have seen that many of the educational institutions, they hire a tailor in their school, and they try to give that tailor ready-made clothes to the students, because they want a specific color and specific clothing for their school. So generally, we have to see that what can be the impact on those ready-made clothes also. So if it is a garments which is having a stitched and ready-made clothes, and if the value is more than 2,500, the rate is up to 5%. But if the value is above 2,500, it is 18%. So it is per piece. So I think we have to look into that. Majorly, we have to see what is the cost of that uniform. So earlier it was higher rate. So now the rate of taxes are reduced to 5%. So I think to that extent, school uniform cost also will get reduced. Now, the next issue is like this tailoring services, because if they hire some tailor to see that the school dresses are getting stitched only by those specified tailors, then if the tailoring services also cost, if you are able to see, the cost is also reduced from 12% to 5% and 18% to 5%. So to that extent also there is a saving in the cost of this uniforms and other apron and all that clothes, whatever the clothing required for the students. I think to that extent there is a saving of taxes for this because there is a reduction of tax on ready-made garments, and there's a reduction in tailoring services also. Now the next important is this printing of question papers, like we are or many other documents. Many of the educational institutions where we have reviewed that they outsource the printing jobs. Like for example, their notebooks, they want that their school logo is getting printed, or they want a specified quality of paper in their notebook. So they will generally try to customize their own kind of notebooks or question paper or any other documents which are required. So the first issue is whether this printing of whatever this question papers or OMR sheets or whatever this relating to the examination, if you are getting printed from our from the printing agency, so earlier there was an exemption, like that exemption is still it is there, but that exemption is there on input services which are there, like if you're getting printed for these online testing services or for result publications or printing of notification of examination, admit card, question paper, all these were all these are exempted because there is a specific exemption which is given in 12 or 17 that any services which are in relation to an conduct of an examination, so to that extent there is a exemption. So based on that, even the supply of services also in this ruling it has held that there is an exemption, there is no requirement of GST. But the next question is, if we are looking this printing of newspaper and book, there is a specific entry which has been made in the notification where they have tried to incorporate this entry of 9988, where they have stated that services by way of any treatment or process on goods belonging to another person in relating to printing of newspapers, books, journals, and periodicals, they have changed the rate to 5%. And printing of all goods falling under Chapter 48 or 49 in first schedule also, they have said because 48 and 49 pertain to the paper and paper products. So based on that, they have tried to reduce the rate of tax to 5%. So even this printing job for other wherever we are giving, the rate of tax has reduced for the job work from 18% to 5%. But if your activity is not falling in this kind of thing, then it will go to the 18%. So if the news, if you're giving your notebook and you want that your school logo should be there, then all any other process you have to do specific customized process for your books and other items. Then in that case, whatever for the printing cost, that cost has been reduced to 5%. I think this will be a huge saving because many of the schools and educational institutions will outsource this task, and always this was a higher cost. So I think now to that extent, there will be a reduction on cost for printing material. And next is newspaper, journal, and periodical, whether or not illustrated or containing advertisement material. We have seen that many school will give that printed souvenir or printed, every year they come out with a pamphlet. So all these kind of items will now be exempted from GST. So that kind of containing advertisement material, whatever it is, journals or periodicals, I think to that extent, there is no such, anyway, they are not going to collect any consideration from the students, but whatever the fees they are going to collect, which also include this cost. So based on that, they have clarified that there is no implication of GST, even though prospectors or some souvenir if they are giving, even it is not having any GST implication. Now, next is, before going into that, the next is, I think we have been discussing in other industry sector also on this intermediary services, which is yet to be notified. We don't know when it will, like possibly, I think after the budget amendment in 2026, the intermediary services, it might get changed on that. But the major issue, I think it will definitely help for the educational institution because the issue of because many of the educational institutions will enter into an agreement with this foreign universities or foreign companies where they enter into a tie-up with that foreign company so that they will be referring the students from Indian company, and then they are going to collect the consideration from that foreign company. So there is a lot of agreements where the educational institutions are entering with the foreign companies or foreign institutions or foreign educational institutions so that the student can get a foreign university-based degree. So there was always a confusion that whether that services, whatever the educational services are entering into a contract with the foreign company, whether can it be treated as an exports of services or whether the educational institution has to pay GST being intermediary services between the student, foreign entity and educational institution. So always this was a issue, and I think for the prior period, the department has already raised the GST for many of the educational institutions. treating it as an intermediary services and levying the taxes for the contract which are entered with the foreign company. But now I think if they bring out this amendment, definitely it will help the educational institution. And if it is based on location of recipient of services instead of this location of supplier, then based on that, they can treat that service as an export of services. And to that extent, there will be a reduction of cost to the educational sector. So I think we have to just wait and see how this is going to be notified, whether it will be retrospective or prospective. With my reading of minutes and agenda, they are trying to give that it will be a prospective amendment and not a retrospective amendment. So we have to wait and see whether for retrospective it will be as is basis, or whether they will be saying that if you are paid, if either it can be as is basis or there can be a levy to the extent of amendment. So I think we have to wait and see. But as on date, I only like to highlight for the education industry, definitely wherever they are having a tie-up with the foreign entities, this will be a saving clause for them, and this will definitely help them to reduce the costs, because if once, even though they are paying the taxes on those kind of services, they may end up being a cost because their ultimately their outward services are not liable for GST. So this is one more amendment which can has effect for the education industry. So basically, I think recently this decision has come for this IDP Education India versus Union of India Rajasthan, where they have tried to they have tried to give a analyzing that it is an export of services and not an intermediary services. So some flavor we can take it from here for the current amendment. And basically here they are trying to analyze that there is a principal to principal arrangement between the Indian company and the foreign IDP Australian company. So there is no three-party contract agreement, and the place of supply is the recipient-based services. So accordingly, they have said that there is no implication of taxes, and accordingly they can claim the refund being the export of services. Only for the intermediary, the implication can be if the foreign company is tying up with the Indian company, Indian universities. I think there can be an implication in such cases if it is a like if the Indian company being a intermediary services. So if they are coming out with this recipient based services, then Indian university will become a recipient based services. I think in that case we have to see that whether we fall under the reverse charge mechanism. So this is the, on one hand it is a beneficial legislation that it is an for the export of services, but on other hand, if it is bringing that same reference for import of services, it can add cost to the this Indian universities or Indian educational institutions. So anybody want to add any thought on this intermediary? Any of the member would like to add here for this educational institution? Hello,
Yes,
am I
ma'am.
audible actually?
Yeah, you're audible.
Yeah. Anybody would like to add here or something? Okay, I'll proceed then. Anyway, we'll wait and see how the amendment will be notified, and then possibly it can be discussed further on that aspect also. The next is this catering services, including this midday meal scheme sponsored by government. As we all are aware that the services given by educational institution to its students or staff is exempted from GST. But if the services are given to the educational institution, then to the extent of higher secondary school, there is an exemption to certain services like transportation services or transportation services or catering services. So even the catering services which are given to the educational institution up to higher secondary school, to that extent it is exempted. Now, basically, we are able to understand that yes, this remains as it is. There is no change as such. But my issue is if the rate of taxes are changed, because we are able to see that there are a lot of educational institutions who are having the in-house catering, where I think today in Bangalore, I'm able to see, I don't know about other cities or many other cities, I'm able to see that they are collecting the fees not only for the education, they are also collecting the fees for the food, because few of the schools want to maintain that nutrition of the children. So they want to have a specified menu every day, and accordingly they go for in-house cooking also, or in-house catering, or they outsource that catering to a outside catering industry. Now the issue here is basically for these educational institutions, wherever they are collecting the catering fees, there are various goods, various products where there is no levy of taxes as on date. Like if they are selling this product as khakra, plain chapati, roti. Anyway, catering services is also a service which is being given. But if they are selling this product as such to the students, or if they are outsourcing to another catering industry, then in that case, there are a lot of food items where the rate of taxes has been reduced to nil. Like for example, I have not mentioned all the products, but I'm able to see that a lot of products which are generally used by the students, there also I'm able to see that there is a reduction in the rate of taxes, whether like, for example, if the khakra, chapati, roti, all this paratha, Indian breads, butter, ghee, butter oil, daily spreads, whatever the rate of taxes were there at 18%, 5%, I think now it has been exempted. So I think definitely whatever they were collecting this catering charges or this food charges from the students, definitely that cost will have an implication, because lot of products, basically essentials, which are that has been exempted from GST. So I think this is also one of the uh, analyzing I was able to do, to the extent of beyond higher secondary. Anyway, they are supposed to charge the tax to them. So in that case, definitely there will be reduction. There is no requirement of taxes if their products are exempted from GST. As such, catering, they have not given an exemption, but for the supply of this kind of products, they have given as an exemption. So the educational institution has to rework on that, whether giving the whole as a catering and taking the benefit, or buying some product and only for processing if you're giving catering. I think that way you have to enter into a contract with your vendors and decide the costing of your catering based on the your specification of the food, and based on the products which have been rate of taxes has been reduced from 18% to 0% or 5% to nil rated. So I think this is one more analyzing the educational institution has to rework with your catering and try to see that what benefit you can take away, so that it doesn't add cost to your product, cost to your services, or cost to your other services. And accordingly, I think to that extent, definitely a reduction in cost for this education in the education sector, wherever they are availing the services of food sectors. And next is this. Any doubt on this food sector? Anybody would like to add? Okay, if there's anything, please let me know. I'll just proceed. Then next very important amendment which is there is transportation sector. I think today we all are aware that the transportation services are given by the schools, or they will outsource their transportation services to other vendors, and vendor will enter into a contract with the schools, and accordingly the school will collect the fees from the students. So this is the one of the model which are generally practiced by the schools. Or the second model is where the transporters are directly collecting from the students, and the school is only referring the transportation, transportation vendor's contact details, so that student can directly approach that transporter vendor, and they can be given an option whether to avail the services of transportation or not. So there are various models in transportation services, and I will tell you this is the biggest implication for the educational institution today. So I am able to see that most of them are either going with the first model or the second model. The first model is the transportation will enter into an agreement with the school, and school will render the services to the students. So in this case, what was happening was, educational institutions, they were paying the taxes to the transporter sector, but they were not able to avail the credit because they cannot charge the GST from the students, because they ultimately it is an educational institution, and they cannot charge this transportation services from the students, because there is an exemption in entry 66 of 12/17. But that's why what many of the schools have done is, they are just outsourcing that to the vendor, and they are telling the students that you directly approach this vendor, and whatever is your transportation fees, you directly make a payment to the transporters. So because of this, many educational institutions have gone for advanced ruling. And recently also there was an advanced ruling where they have tried to clarify that if the students is directly paying to the transportation vendor, then there cannot be an exemption which is given in the entry 66, and accordingly the transportation sector has to charge the taxes from the students because it is not a service which is given by an educational institution to its students. So I think government should rework on this. I think they should give the benefit of this basic necessities of catering and transportation, because ultimately these taxes are getting collected from the students by the transportation service vendor. So whatever they are collecting, they end up paying the GST on that. So now if you see the amendment in 15 bar 2025, where they were saying that if it is in the same line of business, it is not much change. But if it is not in the same line of business, like for example, if the service is given to an educational institution, then the rate of tax is 12% with ITC was earlier, but now they have made it as 18% with ITC. So now these transporter vendors, they are going to charge 18% to their students. So I think indirectly it has added the cost to the students whenever they are going to pay this transportation services cost to their vendors actually. So I think this is one more, I don't know why government would have given a reduction to the at least to the education sector or any other service oriented sector rather than increasing the rate of tax. But as on date, based on the notification 15 bar 2025, the supply of passenger transportation by any motor vehicle wherever the fuel cost is added, the rate of tax has been increased from 12% with ITC to 18% with ITC. So I think this is one more increasing. And few of the schools or few of the colleges, they take the vehicles on rent, and then they try to they just take it as a rental charges and not as a transport by wherever fuel cost is added. So they are only taking on rental services. Like for example, if I'm hiring one motor vehicle, it is say 1 lakh per month. I don't know how many times I am going to use, whatever it is. I've taken on rental basis. So in that case also the rate of tax earlier it was 12% with ITC. Now it is 18% with ITC. So if you go with rental model or directly this transportation services to the students or to the institution, the rate of tax still remains the same. So earlier it was 12% with ITC. So now I think this cost has been added to the students now. So I think to the extent of 6%, it is an additional cost to the students. On one hand, there is an exemption for certain products, but on other hand, whatever the transportation services they are going to avail, to that extent, there is an increase in the cost. Now, I think this issue we are discussing in most of the sectors. Now, we have seen that there is a change in the rate of stock goods. So many of the schools are having the still the stock of those uniforms so that they can use it for next year. So whether those or this stationaries, whatever is there, whether those schools have to reverse the input tax credit based on 18.4, or they can just, or they have to go with this 17 subsection 2 formula, where they have to reverse this input tax credit to the extent of exempt supply and taxable supply. So I think, according to my view, my reading of this 18 subsection 4, where I think that now this goods have been wholly exempt from GST, and if that goods are there in your stock, I think to the extent of input tax credit, whatever is there pertaining to those stocks, to that extent, the educational institution has to reverse in their books of accounts while they are filing the return of September 2025. So this is quite important because it is wholly exempt from GST. Whatever the products I have told in the initial slide, all those are exempted. So there is a requirement to reverse the input tax credit as per 18.4. So here 17.2 is not applicable. Here it will be 18 subsection 4 will be applicable for the products which are sold. On other services, you can apply 17.2, but to the extent of goods which are in stock, that to that extent, 18 subsection 4 will be available. If you have credit balance, to that extent, it has to be reversed or it has to be paid by cash ledger, as the case may be. Anybody would like to add here something? 18.4. I think this will be most important because we have to check and we have to reverse, we have to recalculate this credit, whatever the stock they have maintained, and accordingly the credit is reversed or not. Now next is this affiliation fees. Though this is not brought in the specific notification, but there are recent decisions which are discussing on that, though there is a entry 66A in 12/17, which is effective from 1st October 2024, where they have given an exemption for the affiliation fees which are charged by the government schools basically. Now the issue is, if it is not a government school, if it is a private institutions, whether this affiliation fees which are charged by the university, whether it will be leviable to GST. So there are various institutions who have gone to the courts and try to, though there is a circular on that there is a levy of GST on affiliation fees, they have challenged this circular and they have gone to the court saying that it is not this affiliation fee is a statutory fee and it is not a commercial fee. So accordingly, whatever the circular has been issued, it is beyond the provision of the constitution. And accordingly, this being a statutory fee or regulatory fee, there cannot be any GST implication on this fee. So accordingly, they have concluded in the judgment of Bombay Goa University or North University of Karnataka, where they have tried to say that whatever this affiliation fees which has been collected is exempt from GST. There is no levy of GST, though there is a specific circular saying that it is leviable to GST. So I think this was a recent changes which they have brought it in this. So definitely it will have an impact. So wherever educational institutions were paying GST on affiliation fees, I think based on this exemption notification in 2024 and based on these recent decisions, I believe that there is no requirement to pay GST on this affiliation fee. Subject to that, it doesn't get challenged before the Supreme Court. So I think this is what would like to add. These were the major impact I was able to see for this education sector. And one more, what we were expecting that for the education sector, they should bring out a specific notification for exempting them from paying the reverse charge tax, because as on date, we are able to see that many of the educational institutions are either taken on rent or like hostels are also taken on rent. So they are ending up paying the GST on reverse charge wherever their landlords are unregistered. So I think to that extent, the government should have worked on those costing and they would have given an exemption, because on one hand you have given an exemption to the educational services saying that there is no levy of GST, but on other hand, on the inward services, they are ending up paying the higher GST of 18% on the buildings whichever is taken on rent, or on the hostels whichever are taken on rent from the unregistered dealers. So only the issue here is, can we consider this building as a commercial property, or can it be challenged like a Goa University, where they have said that affiliation fee is a statutory fee and not a commercial fee. So similarly, can we discuss for this building also, saying that the school building or college building is a building which is meant for providing the that is education service and not a commercial building. So can we look into that kind of exemption and try to say that it is not a commercial property, because the word is using is any property. If you read the notification for this property, they have used the word as any property. So whether the school buildings or college building, can we just say that, can we avoid paying reverse charge tax, saying that we are not liable to pay GST, because we got registered only to pay the taxes on these uniforms or the school books or some of the sale of scrap items or motor vehicle or whatever the reasons we have got registered. But or you are providing the services whatever which are not within the purview of exemption, so which is beyond the curriculum. So there are various services where there will be impact of GST. So because of that, many of the educational institutions have registered under the GST law. But the issue is basically the huge cost for the education institution. Whatever I was able to do the cost benefit analyzing after this amendment, I'm able to see that major cost has hit because of transportation services and because of this rentals, this reverse charge tax on this rental services. Otherwise, on one hand, there is an exemption, but on the other hand, there is a increase in the cost of this kind of services. So I think somewhere we have to balance that the exemption should be a complete exemption, not that we are just making a hype that yes, there are a lot of school students exemptions are there, but on other hand, the education institutions are suffering this higher cost of this inward services. So I think this was my cost benefit analyzing of this education sector, and with the limited whatever the change in the rate of taxes, I've tried to highlight in this PPT presentation. So if anyone has any specific query, we can discuss on that.
Ma'am, there's one query from Sujata madam,
Yes.
where the query says that if the caterer set up a store for selling packaged paratha with the registration, will it still be constituted as catering only or and taxed at 5%, or will it be exempt?
No, it is catering is different, and selling this packaged paratha will be different actually. Because selling as packaged paratha will be a goods which will be sold as a goods. It cannot be taken as a catering services. Because catering is something you are catering in as a service. It's not like a sale of food as such. So according to my view, it is not a catering, it is a sale of paratha.
And there was another question on whether, I mean, since we have few institutes providing, as you discussed for the IDP case, where they were the educational consultants for foreign universities.
Yes.
For certain Indian universities and colleges, there have been certain foreign consultants also.
Yes.
And they would be part of the RCM then?
Yes, that is what my reading of that. We have to wait and see how they are going to notify, because the current reading of the import of services, where they say that the place of service should be outside India, right? So if it is for import of services, the place of service will be in India. So if you look for import of services, then the place of supply, if you test the same thing, intermediary under the residual clause, then you will end up paying the reverse charge tax on those services. So on one hand, we are getting an exemption for instead of intermediary services, we are taking it as a export of services. But the other impact is where the foreign consultants or foreign students are referred for Indian university. Then I believe that there will be an implication of reverse charge tax, treating it as an import of services if the place of supply is treated as recipient-based services. So I think that is the implication I'm able to see on intermediary services for educational institution. Because commonly it happens, like from foreign university will definitely refer for Indian university, and Indian university will refer foreign university. This happens in their educational, many of the educational institution enter into contract in such cases. So I think there will be definitely an implication if the place of supply for intermediary is changed to the location of recipient of service.
There was one question with respect to the exemptions on certain educational supplies,
Yes.
such as erasers and sharpeners. Do you see
Like
that? I mean, do you see any cost increase or decrease due to the impact on such products?
which products, sir? I just
Educational products. I mean, the used in education, such as erasers and sharpeners, where probably there was a discussion going on with respect to inverted duty.
yeah. I think for them, for educational institution as such, inverted will not be applicable, because they are not in, first of all, it is being an exempted totally. If it is being exempted, then inverted duty is not applicable in this case, based on this circular 135 and based on this clarification, because it is wholly exempted. So accordingly, whatever ITC is there, to that extent they have to reduce. Only where there is a reduction in the rate of tax, I think in that case they have to carry forward their credit and set off with their outward liability. So in this educational institution, for the product whatever is given, the inverted duty will not be applicable, and they have to reverse the input tax credit to the extent of stock goods which are there on 21st September 2025.
Okay, ma'am. I There's one question from the audience. I mean, it's a mix of real estate as well as the school, where they are constructing a building for leasing to be given to a educational institute. The question remains is whether I will be eligible for availing ITC, considering the Safari judgment.
No, I think now Safari is not effective. Now they have made a retrospective amendment in 17 subsection 5 subsection D. They have already made a amendment where earlier it was plant or machinery, now they have made it as plant and machinery. So I think with that retrospective amendment from 1/7/2017, that will not be effective. And the educational institutions will not be eligible for input tax credit for construction materials, whichever they have used for the purpose of construction. And even the cement rate also it has got reduced. I brought in one of the slide that cement rate is reduced or some construction tile rate is reduced. Definitely it will help for them to reduce their cost, but it will not help them to avail the credit as such. And I will tell you most of the educational institution wherever we are able to do the review of that, we are able to find that they don't want to enter into this rule 42 and 43 formula only. They said hardly 10% will be our taxable and 90% will be exempted. So we don't want to enter this formula every month. So they are just reversing the input tax credit, whatever is there, and they are taking it forward. But majorly for this books and all stationery, whatever they were having, they were maintaining that credit so that they can adjust against those taxable supplies. But because of this amendment, they have to reverse the input tax credit, which are pertaining to this books or stationaries or whatever the items where the rate of taxes are reduced.
Okay. Few third-party suppliers come into picture, as you discussed, with respect to certain exercise books and other things. There have been question has been asked whether a third party conducting some AI related classes inside the school, and there has been a payment from the school to the vendor, and such fees has been also collected from the students. So whether GST would be applicable on that?
Yes, GST is applicable on that because it is not forming part of curriculum. It has been given by a third party vendor. So there is a levy of GST on that, and they are collecting also.
Okay.
Yeah.
Okay, ma'am. Any other questions?
I'll share this presentation, Lakshmi.
Sure, ma'am. Thank you. Thank you very much.
Share it with the members. Yeah.
Thank you, Annapurna ma'am, for an
Yeah.
enlightening session on
Hope it
education.
was educative for educational services.
Not to consider a change in reform from a perspective from an education sector.
Yes, yes,
As you
yes.
considered is generally considered to be exempt, but to understand the nitty-gritties with respect to the costing, because
Yes,
an exemption brings a cost, an additional cost with respect to imports,
yes,
existing stocks, as well as the proposed changes, which could have a probable impact on the entire procedures and the conduct of a educational institution.
yes,
Is makes it interesting.
yes.
Thank you very much, ma'am,
Thank
for
you so
this
much.
session.
Thank you.
Yeah.
Good
Thank you.
evening, Annapurna ma'am.
Yes, hi Vishal.
Hi. It was really very enlightening, and yes, the education sector was very educated. You added many limbs to the various otherwise very straightforward entries. You
Yes.
added a good flavor, ma'am.
Yes, thank you so much.
Ma'am, you can disconnect the presentation.
I think if I connect mine, it will automatically get disconnected.
Okay.
Yes, I think now can see my screen.
Good evening, everyone. Just a small information that Avinash Poddar sir could not join this session due to some health issues. So we have Vishal Poddar ji joining us and explaining the session. To give you a brief, how do I say? To give a brief introduction about Vishal ji. Vishal ji qualified at the age of 21 and currently has more than 2 decades of experience, especially in indirect taxes for more than 1.5 decades. He is a partner at SS Mutha and Company and is also an advisor to Ashwa Legal LLP. He is also empaneled as a GST trainer with ICI. Known for his expertise in indirect taxes, he is also a contributor to various columns and articles in various associations and journals and newspapers. His contribution to includes work related to the ICI's background material on GST and also in the FAQs on GST. Vishal has also co-authored books on GST, making significant contributions to the literature on this domain. His recent book on demystifying GST for the real estate sector, co-authored with Sanket Shah, is a book to be followed for real estate enthusiasts. With this brief introduction, I would request Vishalji to take the session to take the charge of the session. Thank you.
Thank you very much, Nishant bhai, and thank you CGPI for this opportunity. And yes, definitely filling up for Avinash bhaiya is very difficult, but I'm sure the pointers that I'll be raising would at least fall somewhere near to his expertise. So, Nishant bhai, you had posted a question which was jointly for both sectors. So, should I start answering with that first, or I should
We
go to
will
my
take at the end so that it becomes easy because.
So the question that you posted to Annapurna ma'am, that we'll take at the end. Okay.
Yes.
So I'll first complete my entire presentation and then we'll take all the questions because I have a different view. So I think we can take up that. Yeah. So as per the agenda given to me, so I have to cover basically two sectors, textile and the real estate cum construction sector. I have designed the presentation in 4 limbs, as you can see on the screen. So we'll start with the generic overview of this 56 council meeting minutes in 2 to 5 minutes. Then there are some generic impact points which impact both the sectors, may also be impacting other sectors. But since my deliberation is limited to these two sectors, I'll be limiting all my deliberation from the perspective of these two sectors. So we'll go to the second limb and then we'll go to textile sector and real estate and construction sector with all the various impact points of the proposed amendments and whatever material we have from the government side. So let me start with the first limb of today's deliberation, that is the GST 2.0 overview. So when we listen to news, when we see the flyers, and especially when we try to follow what the government is trying to project, it appears that it is a merely a rate reduction process, or this entire thing is this GST Bachat Mela, something how they have coined. But I look at it differently. Yes, though it has been publicized and marketed like that, but I believe it is more of a shift in the understanding of how indirect taxes should be in India. Those who all are following this indirect tax law since the VAT regime and even the earlier the sales tax regime, I was fortunate even to see that during my articleship. So we will find that multiplicity of rates has always been a very common feature in our Indian taxation domain, and especially so when the states had their independent powers. So if you compare the tax rate of, let us say, Maharashtra with that of Karnataka, with that of Tamil Nadu, with that of Madhya Pradesh, with that of West Bengal, you will never find, or I am talking about the sales tax era, you will never find that a particular commodity, let us say the pencil, the sharpener, what we were discussing in the previous session, having the same rate of tax for obviously varied reasons, which are social reasons, which are political reasons, and which are also what is more suited to that particular geography, if I can use this word. However, when we shifted to the VAT regime, even though we could not have a single tax, at least the states endeavored to bring the methodology or the law on similar footing, which happened to a very great extent. Many states had virtually parallel laws. However, still the rates were varied. And then when we ventured into GST, the biggest challenge was how can you satisfy all the states to have the same rate? Yes, somebody will say, ki, Vishal, they did it by giving them the compensation. See, compensation is to compensate the revenue loss. But see, when I am a person, now look at this from political point of view, because when we talk about taxation, you cannot keep the politics and the policy outside. So if I am a particular party which is in power in a particular state, it is very difficult for me to tell to my people that, see, what I had made exempt in the VAT regime, will now suddenly be 12% or will now suddenly be 18%. Why? Because the entire nation is shifting to single tax. This becomes very difficult for a party at the grassroots level to convince to the people. Though fortunately it happened very smooth. There weren't any agitations or any type of mass, you can say, repercussions where people protested against the common rates, because in many states the rate virtually doubled or they increased beyond the limits or the pocket size of the common man. However, at that time also, when we shifted to GST, the thought process was that we will continue with multiple rate to accommodate all these factors, as I said, sociological, economical, geographical, and so many things. However, this particular GST 2.0, which has triggered and which has brought the rates, though I agree, many people will say, Vishal, it has not come down to two slab rate, but believe me, if you see the new schedule, which has replaced the old Schedule 1 by 2017. You will find that out of majority chapters, now when we look at it from the Customs Tariff Act point of view, because when we do interpretation of tax rates, it is through the Customs Tariff Act, you will find that this particular change has tried to unify the tax rates across chapters. So it is not that they have tried to make it two slab rates simply. It has been done in a very purposeful manner, in a very systematic manner, whereby when you start going across the chapter, starting from chapter 01, you will find that in majority of the chapters, the rates are either 0 or 5, excepting one or two items, and this continues for majority of the chapters. And when you proceed with the chapters beyond 24 and 25, you'll find that actually there are only two slab rates. Yes, I agree that for certain special items they are still continuing 12%. For certain items we have that 1.5, 5 and all those things. That is okay. But please understand that from the perspective of the lawmakers, it has been a big change in the thought process, which I believe gives certain indications. The indications that we can draw as tax professionals is that this is not the one-time affair. What I get to see and read, I believe that we will find this in the next 1 year. Maybe it may happen that actually we will move out to become a single tax rate regime in next 2 to 3 years, but definitely next 1 year we will be having many of the products and many of the services rate being unified and brought into two slab category. Second important thing which I identified in all these proposed changes, because some have not yet been notified and not yet been implemented because they have to be made in the law, which I believe will happen in the budget. There is a change again in the mindset from checking first to trusting first. Now you can see this, especially in the refund mechanism, especially in the proposed automated registration mechanism, whereby now the government is shifting to the mindset that yes, I will trust my people. I will allow you refund 90% upfront, and wherever required, I'll do the checking. Only for some risk-based refunds for which the parameters are yet to be shared, we will be doing assessment first. Otherwise, it would be allowed. Now, yes, this appears to be a fairy tale type of a thing because we know how things are happening on ground, because this 90% upfront refund was proposed even in the present law for zero rated supplies, but we know how it is being actually implemented. But I believe that this time, with this particular type of change, and also look at this change from the perspective of what is happening geopolitically. So geopolitically also now India has realized that if we want to be independent, if we do not want to be budged down by any external pressures, then it is very important that we make our domestic market stronger. And that can be made stronger only when the businesses are flourishing, and the businesses will flourish when you keep more trust in them and when you remove all these bottlenecks. So I believe this, the refund and the registration, the for me one of the most iconic proposals, will not be only on paper, they will be implemented. And I'm sure in next few days to see, you will have immediately some advisory initially coming, and then afterwards, whenever it will happen, it will come in the form of amendment in the law. Another interesting thing is, till now, whenever we were talking about our rates, we were giving comparison with European countries because there the overall average tax rate was exceeding 20. So we were finding comfort in saying that, see, my average tax rate as compared to the European countries is much lesser. But again, we have realized that when it comes to competition, we are not competing in the international market with the European countries. We are competing with our own Asian countries, which includes Bangladesh. Then we have the Cambodia, the China, and all these countries. So whenever we are making a comparison as to what are my tax rates as compared to the international tax rates, the comparison has to be done with our competing countries, and that is what has been changed. Now we are comparing, and now we are trying to align our tax rates to an average tax rate, which is now matching with the Southeast Asian countries with whom we face competition in the international market. Another interesting thing is all these proposals of automated registration, which is today one of the biggest hassle any businessman faces. And also interestingly, the e-commerce business operation registration, where I believe that now what I have understood from the press release, because beyond that, there is nothing else. Even in the press release, nothing is given clarity. What I understand is that today, if you have to operate in different states, which e-commerce vendor is required, he has to take a registration for which you need to have a principal place of base, and then you can have multiple places which can add it in that principal place as additional place of business. I believe what they are planning, because if they have to make the e-commerce operation even smoother for a person like me sitting in Maharashtra and doing my business across India, they may allow all the other states registration to be added as additional place without having a principal place. I think this could be the way they could be achieving this, what they have proposed. So let's see how they are going to bring about this particular change. I'm very, very hopeful of the refund and the registration amendments that have been proposed, because both are yet to come. Another important thing that we see is now government is relying more on the technology, and that is where you will find the shift. If you can see, when they allow you registration without checking your documents, when they allow you refund without doing the assessment, and also interestingly, if you know, the GST 80, which is proposed to be functional by this month end and start hearing appeals by December end, you will find that now the thought process is making all these things completely technology driven. Even the GST 80, the filings, the hearings, what I'm getting to here would be completely automated, would be completely online. Now, these are all relying more on technology and relying more on your people. This is what I can draw as an overview when I look at all the proposed changes without going into the line by line items, which is our next part. Now I move on to the second part of my deliberation, which is certain proposals which have a generic impact value. When I say generic, it impacts across different sectors. We'll try to understand and we'll try to deliberate on that. And then I will move to my sector-wise presentation. Now we all know that hotel industry post-COVID is one of the booming industries. But I'm not talking about the hotel which is used by individuals when they are going on a tour or a travel. I'm talking about the hotel accommodation which is used by businesses. Now, many times the businesses, they send their employees or their directors or their partners, they travel. Like many of us also, we are traveling for our various client cases, which is across India. And over there, we have found that the hotel rooms, which were carrying a GST burden of 12%, the entire 12% used to be cost. Why? Because I was not having a GST registration. Now, bringing down this cost to 5% will help me in first manner that at least now my travel and accommodation cost will be reduced, because even if I'm not getting a credit, still the tax burden on me is now only 5%, which was earlier 12%. Also, wherever I was eligible to take the credit, now I'm talking with perspective of real estate sector and with perspective of the construction sector, in both these sectors and also the textile sector, you will find that this credit, even though let us say eligible because you have you have a registration in that particular state, was many times adding to the cost for the reason that in case of real estate, anyways, ITC, if your output is residential accommodation, there is no ITC available. So it was adding to the cost. And even in case of textile, since the textile was under the inverted structure, majority of it, the final products, hence they were never able to utilize this ITC because it was ITC on input service. So even where ITC was available, it was still adding to cost. So I look at this particular amendment from a generic perspective that at least for professionals like all of us who are traveling and for all the different businesses for whom till now this was adding to cost will now be reducing the cost burden. The second generic point which I could identify from this whole 2.0 is relating to job work and professional services. Now they have tried to align it with the main product rate, which is a welcome step. So I found that in many cases it is made 5%. However, there are some cases where earlier the job work was 12% and it has now shifted to 18%. Now, where this is happening, it may now make the companies rethink. Again, I'm talking from the perspective of textile industry. Why? Because again, for textile industry, any inward service is not welcome for the reason that they are never able to utilize the ITC. Why they are never able to utilize the ITC? One, because they are under the inverted duty structure. Two, because anyways under the inverted duty structure, they will never be able to encash the ITC on the input service. Now, again, even though majority of your job work under the textile is under 5%, but wherever you are doing contract manufacturing and let us say it is falling in 10%, it will now require a business process reengineering whereby instead of outsourcing, can I make it my extended arm and do it myself? This, according to me, is a very welcome step, which is reducing the GST rate on the commercial goods vehicle. Now, we all know transportation is one major cost for all sectors, be it real estate, be it your textile, and even the other sectors, because for both your input and your output, for both, you incur a major portion on the transport. And if the tax rates on the vehicles is reduced, like you can see now all these goods transport vehicles in the form of trucks, delivery vans, the GST rates has been slashed from 28 to 18. Similarly, for third party insurance of these trucks, the GST rates has been slashed from 12 to 5%. I believe this will go a positive way in reducing the capital outlay, either if the industry is buying its own vehicle or even if it is hiring a GTA, since the GTA will now get the vehicle at a lower cost because of the reduction of tax incidence, where the GTA is charging under forward charge with 12%, which is now made 18%, still his cost has been reduced because he's now getting it at a lower price, or even where it is under 5% without ITC to GTA, still, since the cost has been reduced to the GTA, I believe this will have some impact on the reduction of the transportation costs in the hands of the industry. Now, very big question which is being discussed across length and breadth all sectors is that we have seen that majority of these sectors have seen rate reduction. Many of them have seen on their outward side and some have seen even on the inward side. Now, when I talk about textile, it is majorly on the inward side because many of the inward items which were earlier at 12 and 18 have been brought to 5. Though there is not much on the outward side except for the specific case that where my goods tag was about 1,000, I was paying 12%. Now up to 2,500, I'll still pay 2,500. That is the only benefit which I can see on the outward side of textile. Similarly, there is no benefit on the outward side of the real estate business, but definitely there are benefits on the inward side. As you can see already on the above part, there is savings on the job work front, there is savings on the transportation front, and also there is savings like in case of textile industry, you know that in many states it is compulsory for them to run their own canteens. So now whatever food articles they are buying, they will be getting it at a cheaper GST rate. And to that extent, there is a lot of ITC which was earlier adding to cost for textile industry, specifically on food articles, will now be reduced. Now, in all these cases, the question comes is what would be the implications under anti-profiteering? Now, why this discussion is more important? It is more important from two perspectives. The first is the legal perspective. As we all know, the anti-profiteering has a sunset clause whereby now no further complaints would be entertained. Now, the question is where the authority is not going to entertain any complaints, in what manner it would be legally implemented by the government, how they are going to legally enforce, if I can use this word. And we all know that there is a list of goods which was released on which the government has asked the authorities to do close monitoring. So even if they're doing close monitoring, the question is, what is the tool? What is the mechanism available in the law for them to enforce? I understand there is no legal mechanism available to enforce the anti-profiteering clause, at least through the GST law. This is my understanding. But bigger than this is my second question. Let us say tomorrow you find or you devise some legal mechanism to enforce this. The question is, how will you count the percentage of reduction in the cost? It is very difficult. The reason for this is one, when I'm talking about a sector like real estate, I'm talking about a sector like textile. As you can see, many of these are reduction in their inward side. And when it is reduction on the inward side, which may be either on the input service or inputs or even capital goods, it is very difficult to identify, to understand how this will be ultimately incorporated in the reduction in price of your final product. Now you will say, why so? The reason is because the costing of these things is not so simple and straightforward. If you look at the costing part, let us say I am a new entrant into the industry. I have a huge capital outlay. Obviously, my recovery or my pricing is designed in such a fashion that maybe today I have done a lower pricing because I'm entering the market. I want to capture the market. I want to establish myself in the market. And I already have a costing which is done on the basis of average of 5 years, whereby I have internally made this costing that on the basis of these costs, I'm going to increase my price as I get established in the market over the next 4 5 years. Now, suddenly this particular change happens on my input side, and you ask me to compulsorily reduce my output price. Now, for me, it is impossible, because if I do that, irrespective of whether there is any savings in my cost on the input side or not, the main point is my present prices are intentionally kept lowered. They are in fact at times even not giving me any profit or giving me very marginal profit, because initially I am a market entrant, I want to establish myself. In this case, if you are simply looking at my current price and asking me to reduce my future price on the basis of this price reduction or the cost reduction, this according to me will be very, very difficult for a person like me to survive. Similarly, taking another scenario of a person who may not be a new entrant, but who is established in the market, but again, owing to various competitive pressure, the person was for the initial period using a lower price. Now, in fact, I'll give you a practical scenario. In case of textile, because of this US tariff, many of these industries had accepted to lower their prices so that they could accommodate the tariff to some extent, whereby some part of the tariff they are absorbing by lowering their price, and some part their counterpart in the US or in the foreign countries are absorbing by managing their profit margin. This is how they had devised the mechanism post the introduction of tariff or announcement of tariff by US. Now, suddenly, when you announce this type of price reduction, or I'll say rate reduction, yes, maybe on my inward side, I'm getting some benefit. Firstly, as I said, it is very difficult to find out how much is the benefit converting into my final product's price. That is very difficult. But even if I devise some costing mechanism, anyways, what I'm doing is right now not going to give me much profit, because I'm absorbing the tariff through my margin. In fact, this 1.5% of cost reduction because of these price reductions on my inward side was at least giving me some comfort to get some margin. Now, even if this margin is taken away, for me, it would be very difficult to survive in long term. So I'm more concerned than the legal side of this on the practical and the costing side of this, that how this would be actually computed, and even if a industry wants to implement, how they will be able to do it, specifically in case of textile and real estate sector, because the rate reductions are on the inward side. And then this great announcement, again, this shows a change in the thought process, whereby after having one circular rescinded on the post-sales discount issue, now they have come up with a new circular, which is a very welcome circular, except for one point. But this particular circular, I will really appreciate, I will applaud this particular circular, whereby they have actually taken bold steps in removing all the present litigation which were there vis-a-vis the post-sale discount issue one, of treating the discount received by the dealer as a different type of supply. Two, treating it as the supply of the same goods. Both have now been negated, except for one limb, where they are saying that where the manufacturer has some direct understanding with the buyer, only in that case, the incentive given by the manufacturer to the dealer will be added to the price. Now, here I will add one interesting lane. We all know what has been given in this post-sale discount, and I'm sure in the other sectors series you have dealt with this discount part in detail. So I'm not going on the discount circular per se. My interest is in focusing or bringing to light one very interesting another litigative point which is presently going on, that is vis-a-vis income tax TDS section 194R. Now, we all know under the income tax law, this 194R has made it obligatory for all these companies that whenever they are providing any type of benefits, which may be in the form of foreign travel or any such things to their dealers, they are supposed to deduct TDS on it under 194R, and which is now getting reflected in the dealers 26AS, and through 26AS, the department is now issuing notice to the dealer saying that since this is appearing as a income, why have you not shown it as a supply in your GST? If I try to draw an analogy, I believe that this particular circular will be a very positive step in helping me counter those claims by the department also, whereby it is not necessary that everything which is coming through 194R in my 26AS would be equivalent to supply. So I believe that we can use this circular to our benefit whenever we are facing the 194R comparison challenges. So these are some generic points. Nishanji, should I take some questions on these points, or I should take the sectors first? Nishanji. Okay. Let me proceed then. So I'll start with the textile sector. Now my presentation has been bifurcated into certain limbs of the textile sector so that we can understand how the changes is impacting the various aspects of the textile sector. So as you can see straightforward on the MMF, that is the man-made fiber, we can see a straightforward rate reduction. Now, this was a long pending issue with the textile sector, and it was creating huge blockage of working capital. Yes, there was inverted duty structure refund, but we all know the challenges with the formula and with the practical challenges that we face whenever we go to get the refunds. So that it was creating more of litigation than the actual benefit. Now I believe that this is a very, very welcome step vis-a-vis the textile sector, that they are now brought out of the inverted duty structure, at least as far as their major inputs are concerned. So with respect to man-made yarn, man-made fiber, these sectors in the textile have been or will be benefited hugely by removal of the inversion in the form of bringing the rate similar to their output rate. Then comes the second category, that is the apparels category. Now we all know the rates have been changed along with the valuation benchmarking. So earlier the benchmarking was 1,000 per piece. Now it has been made to 2,500. Now I heard that there are some confusion because the circular or the notification uses the word sale value. So there was a confusion. I believe there is no confusion at whatever level you are. So right from manufacturer till the retailer, you have to see your final price that you are charging to the second person in the chain. So if I'm manufacturer, if I'm charging it to the distributor, distributor to the wholesaler, wholesaler to the retailer, whatever price you are charging, if that price per garment is below 2,500, then you will go for the discounted rate of 5%. Otherwise, it will be 18%. And I believe, at least if I see the statistics, 70% of our daily use items would now be covered in the 5%, and only some of the branded items or obviously the high price items, which anyways earlier were also having a higher tax rate of 12%, now they will be in the 18% bracket. A major impact creating item on textile is coal. I'm sure many of you all would be knowing that in many processes, coal becomes an important ingredient, especially in dyeing process, whereby coal is required as a fuel in multiple processes for the combustion, for the heating, etc. Now, the rate of coal has been increased when you see from the perspective of GST or CGST, SGST independently. But when you link it with the compensation cess, which was some 400 rupees per ton, and when you find out the present rate change, you will see that the present rate change is virtually bringing it at par with the earlier rate. But a very big plus is that we all know that the compensation cess has the challenge of being utilized against the same output tax, that is compensation cess, which no industry like textile is having because their output is in the form of garments, yarns, etc. Now, the best part of this change is this will also be now becoming part of their utilizable ITC, and definitely this will also go in the inverted structure duty refund, and wherever you are exporting it will go in the export refund. So I believe this will reduce a lot of cost on the textile sector as far as the usage of coal is concerned, and the compensation cess element, which was earlier becoming a cost, will now at least get converted into ITC and it could be utilized. Next, you'll find that the services of water effluent treatment, the rate has been reduced from 12% to 5%. Now, we all know that many of these industries, again, especially the dyeing and one which are using chemicals, release a lot of, you can say, polluted water. And as per the environmental laws, you need to treat this before you can discharge it in the ecosystem. Now, major or large units have their own water effluent treatment plants. But in India, you will find that our businesses are spread in such a fashion that you will have 4 or 5 large units and remaining are medium or small entities. Now, these medium or small entities in a particular area, they have one common water effluent plant which provides them the service of treating their wastewater, and they were charging 12%. Now we all know this is an input service for the textile industry, which was again straightforward adding to cost. Why? Because again, it was coming in the inversion rate, and we all know that there is no refund even today, despite of whatever formula amendment they have done for the input service ITC. So this was adding to the cost. Now this cost will be reduced because the rate has been reduced from 12% to 5%. Next is the packaging material required by the industry. Now, many of these packaging items, yes, some have gone into 18% also, but majorly what I have seen, what you see from the perspective of textile industries, the boxes that are used to pack their final product are or were in 12% and are now in 5% category. Further, as far as the biodegradable bags is concerned, government is definitely promoting this for reaching the sustainability goals that the government has set. So these all are reduced, and I believe this is a very positive step, both vis-a-vis the industry, because again, it is reducing their ITC burden. Again, it is reducing the working capital blockage. Plus, at the same time, because of the promotion of this biodegradable bags, in future, maybe we'll see that less amount of paper boxes or packaging material would be used. Now, the structural reforms as called by the press release is vis-a-vis the refunds. Now, as we have been talking, inverted duty structure refund is or was one of the major features of the textile industry, which is now majorly removed. But still today, textile will be having inversion. One, vis-a-vis the input services. Two, vis-a-vis the other materials which are not their major raw materials, because the major raw materials have been brought into this particular 5% category as we just discussed in the previous slides. But still there are other materials like chemicals, dyes, which are still used by these industries, or the machinery parts which are used by these industries, which are still in the 18%. Now this is creating still an inversion. Now there are two aspects of this. One is in the structural reforms, they have announced that for the first time, they will be introducing this automated 90% refund for the inverted duty structure refunds also, which was earlier limited only to zero rated supply refunds. Now that has been brought to this inverted duty structure refunds. And second is that they have said that it will be risk-based assessment, and where the person is not coming in the risk parameters, it will be automatically allowed in 7 days. If this happens, and as I said at the start in my opening remarks, I believe strongly this will happen, because the government is not only looking at this entire 2.0 as a mere rate reduction, it is looking at it as a major overhaul in the policy, in the thought process. And as I said, it will continue. You'll find major other changes coming up in next 6 months up to the next 31st of March. And in 1 year, you'll find major changes happening at different fronts. Maybe we will see something in 17.5 also. So just these are inputs which shows that it is not a mere change in tax structure. It is a major overhaul of the entire law. Now in this, the inverted duty structure refunds, though today may not be majorly impacting textile after these rate reductions, but as I just said, they are still having inversion vis-a-vis some of these items. And this is where this structural reform will be of great help. Similarly, the registrations here, I feel the major benefit will be related to the second pointer. That is where, though nothing has been specified in the press release, but they have given this indication, which I again mentioned at the start in my generic points, that the e-commerce operations will be given some relaxation, some benefit, whereby maybe they may not be required to have a principal place of business in every state. This is what I'm just speculating, because nothing is given in the press release, but this is what at least my reading says, that you will be registered with one principal place of business in your main state, and in other states where you have to do operations using some e-commerce operator, you will be only adding an additional place of that particular e-commerce operator's godown or whatever warehouses are there. And I believe that that will reduce your hassles of having a separate office or connecting with someone to get an office over there to make a principal place, and then adding all these godowns as an additional place. Secondly, another welcome step in this same registration category is that even for normal registrations, they have said that it will go on the auto mode, because presently we all know one of the biggest hurdles, biggest bottlenecks in GST is getting registered itself, which I really find very strange, because on one side, the law wants you to be a compliant taxpayer. The law wants you to be honest taxpayer. And when I want to be honest, my first step in being honest is by taking a registration, which is always denied. We all have experienced that minimum on an average 3 times your registration application will be rejected for reasons best known to them. And then only through a specific mechanism, you will be allowed the registration. So I believe if they are really bringing the structural reforms whereby, again, for some non-risk categories or accepting some risky categories, others will be allowed automated registrations. I believe this will be a game changer, and we will really see many people coming into the taxation net voluntarily. Next important aspect when it comes to textile is heavily power driven or power dependent industry, whereby for running all their machines, they require huge quantity of power. And now they have shifted from the conventional methods. Yes, still many are using coal, so that coal reduction is also a major part. But now many are shifting to the renewable power resources. And you'll find majorly in the southern part and in the western part that we have these solar and the wind energy sources gaining a lot of momentum. Now, the best part in this is that the goods which were required in setting up a solar power plant or a wind power plant were earlier at the start 5, then they were changed to 12. Now they have been brought back to 5. Now, this again will be proving to reduce the input cost of power for these industries. Again, we all know that whenever a textile mill is setting up its own power plant, maybe in the form of a solar power plant or a wind power plant, generally it is a turnkey project. It is a works contract project which comes in as an input service. The invoice is coming with a input service, though we all know there is that 70-30 breakup, but it is ultimately a works contract bill. And since it is capitalized, they are never eligible to take the credit of this. So again, it adds up to the capital cost, and only the option available is claiming depreciation. Now, by reducing the rate, it will have a big impact in the fashion or in the manner that the immediate capital outlay would be reduced. 7% is a big amount, and we all know that 70-30 ratio, whereby 70% of the works contract bill is attributed to goods, and that is what is reduced from 12% to 5%. So there is an overall rate reduction whenever it comes to setting up of these parallel energy resources. Then giving you some parallels, as you can see on the left side of the screen, I found this image. So I just copy pasted it because anyways, I'm not going line by line on each rate reduction. Anyways, it is there in the public domain. What is important for me is the impact analysis. Now, from the perspective of a textile industry, we have to see the impact on the outward side as well as on the inward side. First, starting with the outward side impact analysis. On the outward side, we will find that the first question that comes is, what will happen to my transactions which are scattered between the pre and the post amendment date? That is, let us say something happened before 22nd of September and something is happening on or after 22nd of September. So how will the tax rate apply? I believe it is much easier when it comes to supply of goods. So in case of textile industries, this should not be a very big challenge. I divide this into two parts. One is the regular sales and one is where the sales are on return basis. Now, when it is a regular sale that is not on return basis, it is simple. Even if you apply section 14, read with section 12, read with section 31, the impact is that what is relevant to see the time of supply in case of goods is only the two limbs, that is the date of invoice and the date of removal, which automatically coincides because of the operation of section 12 and 31. That is why if your invoicing, if your removal is post 21st of September, that is on or after 22nd of September, the answer is simple. Your rate will be the new rate. And if the removal has happened up to 21st of September evening, the rate will be the old rate. I believe there is no much hassle in this, and I'm sure none of you would be having a challenge in understanding this. Yes, there were questions which I think have been answered even by the FAQs, that what will happen if something is in transit? Do I need to revise the e-way bill? The answer is no. E-way bill was raised correctly on the basis of the earlier invoice, and there is no need to revise e-way bill even though your material is being dispatched or delivered post the rate change. Now the question is, what will happen to the transaction where my goods were sent on approval basis? This generally happens in case of goods which you are ordering many times through online, where there is some 7 days or 15 days return policy. Now in such cases, the goods were ordered up to 21st, even they were delivered up to 21st, but the time to get the approval of 7 days, 15 days, whatever is there, is yet to expire. In such cases, what will apply? So the answer is simple. If the approval is received up to 21st of September, the old rate shall be applicable. But if the approval is given post 21st of September, the new rates shall apply. Another question that is asked, for which I believe the answer is very straightforward: what will happen to the credit notes? So let us say the supply happened before 22nd of September, but I have to raise credit note for some reason, which is provided in section 34 after 21st of September. Then for the credit note, whether I have to apply the old rate or the new rate, the answer is simple. The credit note follows the rate which was applicable on the invoice. So whatever was the rate applicable on the invoice, the same rate shall apply for credit note. Next, important factor when it comes to textile is, we just discussed in the previous slides that now majority of inverted duty structure refund impact will be reduced because majority of the raw materials have been aligned with the output. So the input output rate is same. But still, as I said, there are many items on the input side which is still carrying 18%. So it is creating inversion. Now, what is the challenge? Why I have covered this point here? Because even presently, we were facing this issue when we were applying for inverted duty structure refund. Especially, I have found this more in the Tamil Nadu belt. I don't know why. That over there, the department was carrying a view. I believe it. They are still carrying a view that in inverted duty structure, only where your main raw material or the major raw material is having a higher rate, then only IDS applies. But if there are some other materials like packing materials or dyes and inks which are used, even if they are having a higher rate, but your main raw material is having a low rate, like generally this happens in case of cotton based textile, where the cotton is also 5% and the output garment is also 5%. But the dyes, the inks, and all these materials, the spare parts, they are at 18%. So they were not allowing refunds. I believe this is a reason which has to be resolved at the departmental level, because legally there is no restriction, or there is no, I should say, condition in the law where it says that your main raw material should be at a higher rate to fall under the IDS category. So I believe this is not any type of legal or interpretational challenge. It is more the challenge at the side of the department in understanding the provisions correctly. So I believe this should also not be a challenge. Yes, in certain parts where they are rejecting, I'm sure whenever the tribunal kicks in and the tribunal decision starts coming in, we should get a favorable atmosphere thereafter. Yes, the challenge why this is happening is because of the circular. Now, there is one more angle to this. Now, let us say I have purchased these goods prior to the rate change, where they have come at 12%. Let us say I'm a trader. And now when I'm selling it after the rate change, because the limit has been raised to 2,500, my stock is at 12%, or my purchases is at 12%, but my sale will be at 5%. The question is, can I still get the IDS refund in such a scenario where it is not a manufacturing entity, it is a trading entity, and there is no change in input and output because I'm into trading. So the same item I am purchasing and selling. The only difference is I have purchased it before the rate change and I'm selling it after the rate change. Now, as per this circular 135, which is one of the master circulars on refund, the understanding that the department is carrying, and even this circular is percolating, is that such type of refunds are not eligible. Why? Because the goods are the same. I believe if you read the section and also if you follow certain judgments that have come from different honorable high courts, you will find that there is no such interpretation or no such intention of the section or the law. Nowhere in the act or the rules any such condition or restriction is put that the goods should be different. So even if the same goods earlier were having a higher rate and after this rate reduction has lower rate, I believe they are still eligible for IDS refund. Though yes, practically we are facing challenges at the departmental level, but I believe because of the writ decisions that we have till date, and in future whenever we'll have tribunal decision, I think this matter should also get resolved. Now, this rate reduction is going to have a negative impact. Till now, we were talking about all the favorable impacts of this rate reduction, but I believe this rate reduction will have a contrary negative impact, especially on the exporters. How? So let us say I'm an exporter of one of these textile articles where my article was carrying 12% rate. Now, because of this rate reduction, it is coming to 5%. I was selling or exporting these goods under the with payment of IGST option. Why I was doing that? Because it was helping me encash my ITC not only of my inputs or raw materials, it was also helping me encash my ITC vis-a-vis my input service and also to some extent on my capital goods. Because I was utilizing that ITC for paying the IGST amount on exports, and once I was getting the IGST refund, I was getting benefited. In fact, after the removal of Rule 9610, I was even more benefited because I was procuring my raw material using the notifications, which was allowing me to procure it without payment of tax, maybe under advanced authorization. And because of removal of 9610, now I can export it with IGST. So indirectly, I was encashing the otherwise locked up ITC in my capital goods or in my input services. Now, because of this rate reduction, since my output rate is getting reduced, in that particular case, I will be negatively impacted because earlier I was able to encash all this ITC through the export route. Now I will not be able to encash it because the rate has been reduced. So my refund will get reduced. So I will be able to encash lesser amount of ITC. Next, with respect to those textile units, which are again majorly there in the southern part, to name particularly the Tirupur region, I have seen many of the businesses over there very badly impacted, specifically because their major exports was to US. I believe the government should very soon come out with some incentivization, at least for those units who are exporting to US, to counterbalance the tariff impact. Yes, this rate change has brought this special scenario for dealers who had purchased the stock at 12%, but now they will be selling at 5%. So one, if they are able to encash that higher rate input tax credit through their outward sale, even though at lower rate, maybe it will take some time, it is fine. Otherwise, I believe the inverted duty structure refund option can be explored. Another challenge which I have found over here vis-a-vis the textile industry is the job work related issue. Now, textile industry has a very common, I'll say, modus operandi whereby their goods are sent to the job worker for getting some or many of the processes done. So if I am one of the brand stores, I am not doing many of the processes myself. I am sending for different processes to different job workers. Now the issue is, we all know under the GST law, we have provisions which says that whatever goods you have sent to the job worker, it should be returned back within 1 year. And if it is not returned back within 1 year, the challenge is that the principal manufacturer who has sent this goods to the job worker is required to treat this as a deemed supply. Now the challenge is that, let us say this 1 year period is expiring after 21st of September, that is in the new rate regime, which is now a lower rate. Today, let us say this 1 year trigger happens, that is today 1 year expires, and till now I have not received back the goods from my jobber. Now, as per this provisions of the GST law, I need to treat it as a deemed supply, but this deemed supply has to date back to my date of original removal of these goods to the job worker. So interestingly, even though I will be preparing an invoice today for this deemed removal, but the invoice would be carrying the old tax rate because the provision says it would be deemed to be supplied on the date of its removal, not on the date of expiry of 1 year. So this is one of the key points which I felt that the principal manufacturers will have to keep in mind, that they should keep this in mind, that even though they are preparing the invoice in the new rate regime, but because of the operation of the law, the tax rate that is to be applied sorry, will be the old tax rate and not the new tax rate. However, interestingly, at the same time, whenever the job worker will return back the goods to me, the same provision says the job worker, now since I have raised an invoice treating it as deemed supply and invoicing it to the job worker, now whenever the job worker will return back these goods to me, the job worker will raise again an invoice to me. Now, interestingly, I have raised the invoice to the job worker for this deemed supply at a higher rate because I have to take the rate of the date of removal, which is the old rate. So it is a higher rate. But when the job worker is invoicing back to me, the job worker will be taking the current rate, because for job worker, the supply happens today whenever the job worker is returning back. So interestingly, this will create an inversion situation at the end of job worker, though this may be a very limited proportion of transactions, but this I believe can be an impact creating point when it comes to job work related transactions, which are very common in textile. Then comes the input side impact analysis of these rate changes. As I said, IDS is not completely ruled out despite of all these rate reductions, because there are many items on my input side. As you can see, the names, dyes, chemicals, even the buttons, certain labels, are still carrying the high rate. In fact, the rates has been increased to 18%. Interestingly, the coal cess, it is again a very big challenge, though for me now, the change of cess to GST has created a favorable situation. One, if I'm a domestic supplier of textile goods, I'm able to get the ITC. And if I'm exporter, I'm able to, in fact, encash the entire amount as refund under both the options. Earlier, if I was having coal cess credit and I'm an exporter, I was obligated indirectly to make my exports under the LUT option only. Only in that case, I could encash the coal cess ITC. But now, since now there is no more cess, it is converted into CGST, SGST. Now, for me, both options of export will be available for my final product. I can use with payment option or the LUT option. As discussed in the previous slide, for me, the inward cost of the solar or the wind power plant effectively has reduced from 13.8 to 8.9%. How it is we are calculating this effective rate? So 70% is attributed to goods where the rate were 12% has now come to 5%, and 30% were attributed to services where the rate are still 18%. If you take a weighted average, you'll get this rate. Earlier, the weighted average rate was coming to 13.8%. Now it is coming to 8.9%. Next, wherever I am having my own power plant, I'm getting benefited in the form of reduction in my capital outlay. Wherever I am buying the power from outside, still in that case, let us say I have not set up my own power plant, but from the vendor from whom I am buying, since for them the cost is reduced, one, either if they are using coal, the coal cess has gone, now it has got converted into CGST, SGST, still they are getting the complete ITC. So that is where I can bargain with them on the power cost. Or even if they are using the wind or the solar options, still I can bargain with them. Obviously not immediately because they have already done the capital investment, but wherever I am entering into now new power contracts with the upcoming power generation plants who are going to set up the plants post this rate reduction, definitely I should bargain on the power price. I have got the benefit of getting the packaging item at 5%, but the packaging industry has now come under the inverted structure because their outward is 5%. The boxes have been reduced to 5% as we just saw, but their inputs are still at 18%. So for them, there is an inversion. Now this may create a problem to me. How? For me, even though there is no inversion because I am getting the boxes at 5%, but since the industry which is manufacturing the boxes is coming under IDS, if it is not able to encash its entire ITC under the IDS mechanism, definitely some of the burden will be passed on to me in the form of increased cost of my boxes. So this is how I as a textile unit may get impacted. There is no rate reduction on my machinery side. Majority of my machines, barring one or two, are still under the higher rate of 18%. Yes. Now, there is a reduction in cement GST rate from 28 to 18%. This is going to have a positive impact on me. How? We all know that textile industries are always large industries and always having huge investment in their structures. The structures may be part of plant and machinery or they may be not. In any case, cement, which is used, and you'll find that regularly for either the regular upkeep or for adding up a new building or for constructing some retention wall or something, they keep on having these expenses on works contract services, or they are buying the cement and doing the construction activity or the repair renovation activity themselves. In all these cases, again, the cost that is incurred on cement should go down for two reasons. One, the cement output GST rate has been reduced from 28 to 18, plus the cement industry are using coal as one of their inputs for their processes. Now, since the coal cess has been converted into GST rate, the cement industry will be able to utilize that coal cess, which is now converted to GST. So it will be now utilizable credit. So because of both these reasons, the cement output rate should come down, the cement cost also should come down, and the cement output GST rate has come down. So for me, the cement, which is a cost, whether it is capitalized or it is revenue expensed out, in either case, I will be benefited. This is my implication, though this may take some time till these costs gets absorbed and all the benefits get actually converted into reality at the end of the cement industry. I believe this will be a major benefit to me as a textile industry. Now we all know there is this proposed amendment to the place of supply vis-a-vis the intermediary services. Now, if I'm a textile manufacturer, for me, this intermediary amendment, I believe, is now going to create a challenge. What is this challenge? Till now, when I appointed an intermediary who was in foreign country, what was that intermediary doing? The intermediary was exploring new market, new customers for me, and I was paying the intermediary a commission. Till now, I was not paying any GST on this commission under RCM because for me, it was not coming under import of services. Why? Because the place of supply, as per Section 13(8) of the IGST Act, is outside India because my intermediary is outside India. So I was not liable for any 18% RCM. Now, once this amendment kicks in, which I believe will be proposed in the upcoming budget, I will now have a new cost addition again on my inward side, which will be in the form of paying 18% RCM on these intermediary services, which are my inward services. Again, it will be creating an inversion, but since it is input service, I will never be able to get the entire benefit. And also I will never be able to encash it to my regular route. So this could be a challenge for a textile industry. So this intermediary amendment could be indirectly adding a cost to the textile sector. So these are some of my tax implication when it comes to the textile sector. Um, if you want, we can take questions, or I can move on to the next part. I'll just take 2 minutes break. Now we move on to the second sector. Again, in this sector, I have not found any major amendment on the outward side. Whatever amendments we have are majorly on the inward side. So let us understand these amendments, and I have a different perspective of looking at this sector. So this is a list of rates which I believe are aligned to this sector and where there is some amendment. Now, interestingly, after this electrical wiring and switches, you'll find that I have included something which is actually not directly related to this sector, that is the real estate or the construction sector, like air conditioning, ACs, dishwashing machines, television sets, small cars, motorcycles up to 350cc. Now, they have no direct linkage with the real estate sector as such, but I have purposefully included it over here. Reason one, as we all know, the inward side of the real estate sector is again seeing some rate reductions. One, as I have highlighted, the cement rate has come down to 18%, we just discussed. Another important rate change is in the marble blocks, which is used in many areas for tilings and all. That has come down to 5% from 12. Bricks, sand lime bricks, and the stone inlay, all these have also come down from 12 to 5%. Now, these may not be adding up a lot to my cost, but if I calculate the average, what I am getting generically, there could be 1.5 to 3% of reduction in cost from the perspective of a builder if all these inward side rates are reduced. Now, again, the first point which I discuss in my generic pointers, that how this rate benefit can be passed on. If I'm saying the rate benefit is ranging between 1.5 to 3%, how it can actually be passed on by the builder developer to the client or to the home buyers, or even if there are commercial property buyers like shops or offices. This is a challenge. Why? Reason one, these are the changes or the rate reductions on my inward side. Now, let us say as a builder, my project is nearing completion. Now, you'll find that none of these items, which are my inputs, are required at the end of my project. So, I have already consumed this, I have already utilized it at a higher rate. Now, will you expect me to sell my shops, my flats at a lower rate considering these rate reductions? Answer is no. Secondly, let us say my project is still under construction phase, but let us say I've already purchased these items. Many times the builders stock it as per the requirements or considering the fluctuation in market prices, especially when it comes to cement and when it comes to sand. They many times procure it considering the market availability, non-availability, or the fluctuation in prices. In such cases, let us say the major requirement of these items is already procured by me at a higher rate, and now I'll be using it in my completion of the project. How can you expect me to pass on this benefit? So this is a practical challenge. Despite of that 171, whether there is any power there or not, that is a secondary part. Legal, see, the law can be amended, the law can bring out the legal options through other laws also. And if the government has already mentioned that they are going to monitor the rate change, definitely they are having some mechanism through which they will be enforcing. But my question is different. Besides the legal challenge, the practical challenge is even bigger. How can you simply ask every person who is selling the output to reduce the price by 1%, 2%, 3%? Secondly, when it comes to a real estate sector, there is no standardized price. We all know the prices are very much market driven, very much driven by the sentiments, very much driven by what is happening in the other sectors. Like if my other sectors are in boom, then definitely my real estate is in boom, because many times the people park their money in real estate. If let us say a particular area is developing, now let us say we are saying that many of these because of H1B visa sanctions, let us say people will be coming back, and we foresee a new technology hub being created in India. Let us say a new IT hub is getting created in India, and tomorrow we are exporting our IT services outside because all these people are coming back. And let us say a new city or a new area is being developed, and which is actually happening in certain parts of India. We'll be realizing it very soon that this will be a reality, that certain cities or areas will be the new Silicon Valley of India. Now, in such cases, suddenly the prices of those areas will shoot up. But the problem is, how will you manage or how will you show that you have given this rate reduction? So even if the government wants to implement through some legal channel, the practical implications are very high. And this is where I have given you the rates of the other items. The other items rates which I have given you is because I believe the builders will come up with a new mechanism of not giving a straightforward reduction in the prices, rather giving something else which is required by a home buyer like an AC or a dishwashing machine or even a small car as a complementary item, including why? Because the GST rate on the cars have been reduced, the compensation cess over there has been reduced. So this could be a different way of passing on the benefits, so they can also comply with the requirement of anti-profiteering and at the same time use it as a even more impact creating marketing tool by giving them something which is required by the houses. In fact, because of this, there is another possibility that these houses will be now sold in a more you can say completed manner. Like in many parts of India, in many cities of India, you will not find furnished flat as one of the common saleable items, but maybe considering these rate changes of ACs, dishwashing, television sets, etc., tomorrow you may find new business models coming up whereby the builders will prefer giving you a furnished flat so that it can be means the builder can use it as a new marketing model or as a new business model. That is why I just covered those rate changes over here. Let us now go to the impact analysis of these rate changes on the real estate sector, both on the outward and the inward side. I believe there could be a slight different way of looking at section 14 when it comes to services. So as we discussed in case of textile, when it is coming to goods, there was not much challenge because once your supply, that is your removal, is happening after 21st of September, there is a simple answer, new rate will apply. But when it comes to services, and specifically a service like a works contract service, which is a continuous supply of service, I believe section 14 has to be looked more closely. One, because it is a service where now the third limb is also getting added. So one limb is invoice, one limb is supply, and one limb is now getting added is the payment received. Now, how section 14 will have implication? So the answer given in section 14 is you have these three limbs. One is the date of invoice, then the date of supply, and the date of receiving payment. The answer given in section 14 is where out of these three, any two are happening up to 21st of September, you can use the old rate. But if any of these two is happening after 21st of September, you will use the new rate. So wherever there is reduction, though there is no reduction on the works contract side, but just adding a pointer over here, wherever there is a reduction vis-a-vis service, the limbs that have to be checked is out of these three, two, if they are happening up to 21st of September, you apply the old rate or the new rate. But when it comes to real estate sector, I believe section 14 will have implication only when you look at section 14 from the side of your inputs like cement or like bricks or those things where the rate reduction has happened. So over there, I have already answered in the textile sector segment that over there, the answer is very simple. If your delivery, that is the goods, are removed from your supplier up to 21st of September, the supplier would be charging a higher rate. Otherwise, the supplier can charge the lower rate. Now, as I said, maybe a new business model may come up whereby a furnished flat may be given, but there are some present challenges and I'm expecting clarity on this. So these are not yet clarified. This new scheme is not giving any clarity on this, but there is a lot of question about how to do the treatment of additional work done or additional parking provided by the builder to a particular home buyer. Whether it should come in the same rate which is applicable to the supply of that flat, or it should be considered as an independent supply and it should be charged at 18% without any month line deduction. I believe this should be clarified in the upcoming next 6 months where more changes and more favorable clarifications are expected. I will put this as a poser where I believe these should be clarified. Another practical challenge which we all are facing in this sector is with respect to furnished flats whenever they are supplied in certain parts of the country. The question is whether the supply of furnished flat should be considered as a composite supply or a mixed supply. Again, I believe a clarification should be given. Again, presently, on the outward side of this sector, we are facing the challenges when it comes to the taxability of JDA, though we all know that JDA is according to me, now very much settled. Settled in the sense that we have a clarity after this new scheme, but still there are different types of practical business transactions where we are still finding many people facing challenges. I believe those things should also be taken up by the council and clarity should be given. Also, there is a very big litigation which we have now started facing in this sector is that is where you started the project before 1st April 2019, that is in the old, you can say GST regime of real estate, but the project is going forward up to and getting completed in the new regime. So we call it as the ongoing projects. Now, what is the challenge when this project is done through the JDA route? A very big challenge is that who is required to pay tax on the TDR, that is the development rights component, whether it is the landowner, because under the old regime, the landowner under forward charge was required to pay, whereas under the new regime, when the project is completed, the builder is required to pay at the end of the project under RC. So this is another challenge for which I believe the group of ministers which is there, which is set up for real estate, should clarify. And my understanding or my discussions with the particular sector people say that we may see another new regime in the real estate sector, which may be kicking off from 1st April 2026. So I'm putting all these posers for those new schemes. Yes, this sector is also having an impact in terms of a lot of fake invoicing being identified in this sector. Now, I believe because of the reduction of the cement GST rate from 28 to 18, because cement was one of the tools which this type of fake invoicing groups were using. They were using cement as one of the products for doing the fake invoicing entire circuit. I believe after the rate reduction, this may be addressed and this may be reduced. This is just my speculation. Coming on the input side, inward side, because there you have majorly the rate changes. As we discussed, the cement rate has been reduced. So there should be some impact of reduction in the construction cost. But yes, as I said, this will happen only where the cement is procured by these contractors post 21st of September. Secondly, I mentioned this when I was discussing the input side of textile also, that vis-a-vis the cement industry, which is also buying coal, from the perspective of cement industry, the output price of cement should also be reduced. Besides the tax rate, the output price of the cement should reduce, because now they will be eligible to get the compensation cess credit, which is now converted to CGST, SGST on the coal, which is one of a major fuel inputs for the cement industry. Similarly, the reduction in the rates of marble granite blocks will help in lowering the cost where these are used in flooring, tiling, etc. Further, there is a cut in job work for bricks, where for job work on bricks, the rate has been brought at par with bricks. So bricks is 5%. So the job work has also been brought to 5%. We still find this in smaller cities and rural areas where this is used as one of the major inputs in the housing sector. So overall, I believe more so the individual housing construction will go down, may not be at a level of a project. But yes, if let us say I'm an individual, I'm making my own row house or I'm making my own bungalow, for me, there will be a bigger impact of this rate reduction as compared to where it comes to the builders who are doing it as a project, because many times their project are on a running basis. So I believe there it may not be having such a great impact. So with this, I've completed my presentation in totality. So now I can keep the forum open for all question and answers on both sectors, on the generic points, and also on any other part relating to this particular 2.0. So I posted to the.
So Vishalji, there was a clarification requested for fly ash bricks.
Yeah, it is 12%. Here I'm not talking about the fly ash bricks. It is 12% only.
Okay. Uh, Regarding ITC on goods services for building on lease for educational services.
Yes. Uh, See, Nishanji, I have a different reading of that famous judgment of Safari Retreat by the Honorable Supreme Court. I believe the effect of the judgment is not nullified by this retrospective amendment, which is also now notified. I don't believe that the judgment is totally made null and void. Why? Because if you read para 32 of that judgment, it is specifically talking about the scenario that where the building is constructed for being given on rent or lease. The judgment says that the reading of section 17(5)(d), which is the whole crux of this, there were two challenges. One is plant or machinery, which has now been retrospectively rectified, but the other part is for own use. And the para 32 of the judgment says that still that own use, which is not amended retrospectively or rather not amended at all, still holds good according to me. And wherever you are constructing any type of building which is to be given on lease, I believe 17(5)(d) will not impact and you should be eligible to take the ITC. This is my reading and understanding, sir.
Okay. So then I have my own question about
Achha, there are no other questions in the chat.
So no, I mean the last question was posted by myself.
Okay, sir.
See
You
that,
may take that.
I mean, whenever we talk about the complementary items,
Yes.
ACs, and where we discussed that the credits can be passed on. So whether they would form part of a mixed supply or they would be forming part of the original construction services.
Firstly, you're asking this where you are saying it is given complimentary, or you are saying it is now I'm a builder, I'm giving a furnished flat.
A furnished flat. Let's look at a furnished flat so
Yeah,
that
yeah.
it becomes easy.
Now, see, when I'm giving a furnished flat, see, my understanding of this concept of composite supply and specifically the word naturally bundled is that what is naturally bundled? Because I think that is the whole crux of the issue. If something is naturally bundled, it will be getting classified as composite supply because otherwise all other limbs of the composite supply requirement are satisfied. There are more than one taxable supplies. There is one principal supply. Everything else is satisfied. I think the whole challenge is on the word or the phrase of naturally bundled. If I read the CBEC, which was earlier CBC, now CBIC education guide, which was released during the service tax era, I believe we get some uh, inputs from there. And over there, one of the very interesting inputs which was given because this concept is borrowed from the service tax regime, and we have that education guide which says that you have to see the market. You have to see how your suppliers are behaving. You have to see how the buyers are perceiving a particular transaction. If the suppliers in that market are in general supplying it, like in this example, furnished flat, then it will be considered as naturally bundled. Now, here the question is, when you look at this particular concept from the perspective of whole of India, you will find that it is not naturally bundled because in major parts of the India, it is not happening. Even if you look at it from a city perspective, let us say Pune, which is today a very fast developing city when it comes to construction and development. Now Pune is expanding length and breadth. Even in Pune or in any city for that matter, you will not find that every project is going by the furnished flat mechanism. But again, within Pune, you will find that there are different categories of builders and there are different categories of projects. I believe the concept of naturally bundled should be looked keeping in mind the nature of project and not only a city or a particular geographical area to decide whether it is naturally bundled or not. So answering you straight, if a particular project of a builder or if similar projects like nowadays we have this gated community concept or very soon we are having these high-tech homes like you'll find many of these homes are designed in such a fashion that they are low on the energy consumption. Now all these new concept homes, I believe these all items should be or will be considered as naturally bundled, but for regular type of homes, standalone buildings, or the regular type of projects, these will not be. So if in those projects, if any furnished flat is given, in that case, I believe it should be classified as a mixed supply. But where the project itself is designed in such a fashion, I believe it should be classified as a composite supply. This is how I am interpreting and reading the naturally bundled phrase.
The whole thing is pioneering something would cost you something much more than regular.
Yes.
If you
But
start
I
something,
believe very soon because see, you would be knowing that there is a GOM constituted for reviewing the entire real estate sector. Though it was sidelined because of all these other changes coming up. But very soon that GOM will be active again. And I am very hopeful that by 31st March 2026, we'll have the real estate 3.0. We already have real estate 2.0 from 1st April 19. We'll have 3.0 from 1st April 26. Let's hope. And in that, all these things will be covered.
Sure. Hope is a good thing in GST at least.
Yes.
Any more questions from the audience? Okay. So currently there are no questions. Uh, thank you, Vishalji, for a marathon session on textile, which is again a big sector, and then coming back to a completely opposite session on real estate, where there is no credit, there is no ideas, there is nothing else, but interesting sessions. And thank you for presenting it in a short span of time. Uh, to replace Avinash ji and presenting this is an honor. Thank you
Yes.
very much, Vishal sir. Thank
It
you.
is my pleasure. Thank you very much for this splendid opportunity. And I thank all the participants for being there throughout the session and enriching with your questions. Thank you, CGPI. Thank you, Nishant Bhai.
Thank you.